Hello, good morning everyone. Welcome to Phillip Securities Research Morning Call for 4th of July 2022. For stock counter updates today we have the place holdings and Uni-Asia, while for macro and sector outlook we have Singapore Banking Monthly and Singapore Weekly. Without further ado, I would like to pass on to Glenn to get started with Singapore Banking Monthly. Thank you.
Thanks, Ambrish. So we'll start off with the banking Monday. So for the interest rates, they continue to increase in June, and the 3-month SOR was up 33 basis points month-on-month to 1.8%, while the 3-month SIBOR was up 28 basis points month-on-month to 1.49%. And this is the highest interest rates have been since Feb 2020. The 3-month SOR is 36 basis points higher than its second quarter 22 average of 1.44%, and has improved by 156 basis points year-on-year, whilst the 3-month SIBOR is 27 basis points higher than its second quarter average of 1.22%, and has improved by 106 basis points year-on-year. Now moving on to the next slide. The loans growth over the past 2 years, we can see that it's on par with the nominal GDP growth. So the loans growth over the past 2 years at a CAGR of 7.5% is on par with the 2-year CAGR of nominal GDP at the same 7.5%. So this is unlike the 2008 global financial crisis provisioning cycle, when loans growth was outpacing nominal GDP growth. The 2-year CAGR of loans at 25.3% compared to the nominal GDP at 20.9%. And we believe that this is indicative of excessive lending by the banks. It's similar in the 2016 oil and gas provisioning cycle, where loans growth also exceeded nominal GDP growth, with the 2-year CAGR of loans at 1.99% compared to the nominal GDP at negative 1.15%. Now moving on. You can see Hong Kong's domestic loans growth was 1.78% year-on-year and 0.46% month-on-month in May. The month-on-month uptick in loans growth for May was the highest since January 2020, and the year-on-year loans growth was up 5 basis points from April's loans growth of 1.73%. For Malaysia's domestic loans growth was 4.99% year-on-year and 0.28% month-on-month in May. The increase year-on-year in May was the highest since March 2019, and an increase of 1 basis points from April's loans growth of 4.98%. While the increase month-on-month was a decline of 13 basis points from April's loans growth of 0.41%. Now for the next slide. The preliminary SDAV for June dipped 5% year-on-year to 1,141 million as the community COVID-19 cases begin to fall, whereas the VIX averaged 28.3 in June, and this is down from 29.3 in the previous month. The top 5 equity index futures turnover saw an increase of 25% year-on-year in June to 16.66 million contracts. And this is mainly due to the higher trading volumes of its Nikkei 225 index futures and the Nifty 50 index futures. Notably, the FTSE China A50 index futures increased 9.4% month-on-month to 9.43 million, and the Nikkei 225 index futures increased 52.4% month-on-month to 1.75 million, while the Nifty 50 index futures fell 7.6% month-on-month. So for the first half of 2022, the top 5 equity index futures turnover saw an increase of 13.9% year-on-year to a total of 93.8 million contracts. And this was mainly due to an increase in the trading volumes of its Nifty 50 index futures and the FTSE China A50 index futures. So we also estimate the SGX securities and derivatives volume for first half 2022 was down 3% and up 14% year-on-year respectively. Okay, so now moving on to the next slide. So we maintain overweight on the banking sector and remain positive on the banks. The bank dividend yields are attractive with upside surprise due to excess capital ratios. The stable economic conditions and rising interest rates remain tailwinds for the banking sector. SGX is also another beneficiary of higher interest rates. So that's all I have for the banking sector. I now hand it over to Terence.
Thanks, Glenn. The next counter update we have is the Place Holdings, which is a Phillip on the ground. We have no coverage on the Place Holdings. The Place Holdings is listed on the main board of the Singapore Exchange. It has a primary focus on integrating traditional businesses and new growth opportunities in the digital economy. It has three main businesses: property development and property management activities, and last but not least, cultural tourism with new retail. In terms of their latest corporate update, the Place Holdings and Stellar Lifestyle, which is a business arm of SMRT Corporation, has entered into a collaboration agreement to develop LIFE or LIFE omni-channel ecosystem to improve commuters and communities' lifestyle experiences and enhance SMEs' capabilities within Singapore's digital economy. So the acronym for LIFE actually stands for Logistics, Immersive, Futuristic, and E-commerce. It's quite a mouthful, but what this is supposed to do is have this sky screen here that you see on your left-hand side. The Place Holdings will invest approximately $200 million in this ecosystem. Both firms will spearhead Singapore's first sky screen attraction, which is a suspended 200 meters long video screen that is an enhanced version of Beijing's iconic spectacle, the Place Sky Screen, as a catalyst for new tourism and retail experiences in Singapore. The LIFE omni-channel ecosystem aims to improve commuters and communities' lifestyle experiences, enhance SMEs' digitalization capabilities, and boost new business vibrancy within Singapore's digital economy. Both the Place Holding and Stellar Lifestyle also see opportunities to scale this sky screen across emerging digital markets in Asia. That's all for me for the Place Holdings. I'll now hand over the time to Paul.
Thanks. We'll move on to Uni-Asia Group Association. Our report was issued on Friday. Do know that the Phillip Securities Research has received monetary compensation. So this is the paid research report by the company. So the title is a new and higher plateau because we think the dry bulk freight rates will remain elevated for some time. Next slide. So what does Uni-Asia do? So most of the revenue for Uni-Asia, the large part of it comes from the 10 vessels that they own. So these are bulk carriers, which I'll explain a bit later. These are handy size. So these are the smallest of the four types of bulk carriers. I mean, the four large types of bulk carriers. The other part of the business that they undertake is also residential development in Tokyo. So as you can see from the picture, what they do is from some of the old sites, the picture on the top, they will redevelop it into something more modern only in Tokyo. And they will thereafter find a tenant and then rent these property projects out. Another part of the business that they do not on the slide is they will take like a maybe 5 to even 10% stake in some office buildings and just sell them off as strata title basis. This is what they've done since 2010. Next slide. So what about carriers? So for those who are not particularly clear, so the picture is a bit not that clear, but on the left you can see there are 4 types of bulk carriers. Handy size is the smallest, which is mainly what Uni-Asia owns. And the other 2 listed bulk carriers, I guess in Asia outside of Japan, is Pacific Basin and Precious Shipping. So both also on the small category, normally in the handy size of Supermax. The next largest would be the Panamax. For what it's worth, they call it a Panamax because it's large enough to cross the Panama Canal, and likewise there's a Capesize because it can cross they usually go past the tip of South Africa, but that's usually the largest. So in terms of the cargo, bulk carriers carry is usually grains, coal, iron ore. I mean, the main destination is into China. The minor bulks are what the smaller vessels carry. These are usually grains, oil, sugar, and so forth. You can just generalize that anything that cannot be containerized will be actually carried by the bulk carriers. The chart on the right is a Baltic Dry Index. So this is index or the freight rates, that means the charter rates, which is important for Uni-Asia because they own the vessels and they will charter them out to shipping companies or something like maybe a Pacific Basin and so forth. So as you can see from the charter rates on the right, oh, sorry, I'm not sure. Didn't know the volume was that low, but if you see from the I already max the volume. Sorry. So if you look at the chart on the right, so this is the Baltic Dry Index, and what it refers to, that you will notice that in 2004 the Baltic Dry Index spiked up. Mainly because when China entered WTO, they started to import more items and so forth. But the big super cycle, as you can see from the index, it was usually 2000, then it spiked up to almost 12,000. This is the, I mean, they call it the super cycle. And this happened in 2008. This was the result of when the global financial crisis, for those who can still recall, China undertook a massive infrastructure stimulus. And as a result of this, China started to import lots of iron ore, for steel, lots of coal, cooking coal for power generation, and so forth. As a result of this, you can see that the dry bulk index, which is basically an indication of the freight rates or the rental rates for ships, I mean, just to make it a bit more layman, spiked up. But since 2008, you can see the collapse is, I think it collapsed of probably 80% or so. And since then, it has been extremely weak, below the average of 2000 for almost, I think, more than 10 years. But in 2020, you can see that the index on the far right started to pick up to almost 4,000 or 5,000, and that's mainly because of supply constraints and so forth. And we're beginning to see the index again coming back up. Next slide. So for us, what is happening? So the chart on the left is the actual freight rate that Uni-Asia enjoys. So this is what they charge the customers. So in the first quarter of 21, this is calendar. So they were charging about 10,000. You can see the chart on the left. Then first quarter 22, they are charging now 18,000. So there's like an 80% jump year on year. So in the first quarter, sorry, just to go back to the bullet points, they had, for their 10 vessels that they own, they were charging 10,000. Then now it's jumped 80% to 18,400. So this is obviously extremely good for the revenue and also for profits. And the other part is that 9 out of the 10 vessels that they own will be due for renewal by in this year, FY22. So they can enjoy the charter rates. Only one vessel will only renew in FY22. So we are expecting record earnings from them. So we think earnings can jump up by almost 40% year on year to 25 million. I think the prior year was for 18 million. The chart on the bottom is the Baltic Dry Index. They got handy-size, Supramax. So this is more relevant for them because they are mainly on the handy-size, the smaller type of dry bulk carriers. So you can see that the blue line, so this calendar, so important that the blue line remains above the beige line, which is 2021. So only in June we see it coming down, but at least for the first half, we know that they should report strong earnings, considering the 2022 freight rates are so much higher than a year ago. But we think the freight rates will continue to rise because of the supply constraints. Next slide. So the table on the left is probably the most important part. So what we see is record low vessels on order. So this is the number of vessels being ordered. So if you look at the number 6.7, so what it means is that of the total dry bulk fleet of everything, let's say 100 vessels, let's say there's 100 vessels in total in the world, there's only 7 being ordered. And this is the record low. This is like the lowest on record. Obviously, you can see from the table, it was 80% or during the peak when the super cycle happened in 2008, 2009, everybody ordered and they've been suffering since then. But we think there will still remain, the supply constraints can at least remain for the next 1 to 2 years. So in terms of the bullet points again, what is happening is that the yards are very tight. The yards that build vessels, firstly, a lot of them in China have kind of closed down. Although there are no official numbers, so we can't really get a hard data from it, but just from articles and so forth, a lot of yards in China have closed. The second thing is that even if you're open, most of the yards now are taking in container ship orders. I think the likewise for Yangtze-Jiang, because containers are usually larger in size, larger in value, and there's better margins. So most of the fleet on order that they will do, they prefer is containers, and because container companies, shipping companies have done so well. The freight rates are up 5 times. They're willing to even pay cash to get their orders. So there isn't any supply or limited yard capacity for dry bulkers. The other thing why supply is tight is a bit more unique. Probably may not be that well known. Is there's an IMO 30 coming up, where they are trying to reduce the emissions of vessels, I think by 40% by 2030. But the problem right now is most of the fuel types cannot meet this, and as a result of this, a lot of ship owners such as Uni-Asia are not ordering ships because they are uncertain, because when you order a ship, it has to last around 20 years. So the current fuel type or engine type cannot meet this, and because they're talking about ammonia, methanol, some LPG, so it's really uncertain. So a lot of ship owners are very hesitant to buy. They may buy second-hand vessels, but new vessels is something that they are very hesitant. So as a result, there's also a standstill of not ordering, and this is going to affect supply too. The other point is just another point that although on order is, let's say 7%, but the vessels more than 20 years is about 15%. So what it means is that even if they do get new ships, so even if this 6 to 7 new ships, let's say for argument's sake, come in, there's maybe 15 ships that are maybe 20 years and older. So in the end, you may not actually get a net increase in the amount of ships out there. It may be just a renewal. That means they might just return the older ships and then just change it with the new ships. This is not happening right now because freight rates are so high. So even if it's a 25, 30-year-old ship, so long as it's allowed to be used, I think the ship owners would definitely not want to scrap anything. They just keep on using. But this will be a phenomenon if freight rates were to come off a little bit. Supply could still be in check because there's too many old vessels, especially for the handysize. The other thing that's holding supply, effective supply, is the inefficient supply chain. So what we are trying to say is that there's a lot of port congestion right now. So as a result of this, a lot of the ships are stuck at the ports. Of course, this is improving a little bit, but they remain at the ports, and as a result of that, they are not being used to deliver iron ore to China and so forth. So there's a lot of supply stuck at the ports. The other thing that's affecting supply is because of the high bunker or fuel costs or oil petrol price. A lot of owners, what they do is they actually do slow steaming or sail the ship at a slower speed. I mean, that's a fancy word for sailing it slower. So again, this is another thing that causes the supply to be removed from the market, because the ships are all in sea, traveling very slowly, and as a result of it, they can't take up new routes and so forth. So for demand is always very tricky. I think for us, we are mainly focused on supply because demand is volatile. It's almost, it's really hard to predict. But so for us, most important is supply is constrained. But at least for supply, I think it was positive that despite China shut down and so forth, the freight rates continue to rise. So one big demand driver could be if China were to reopen and announce more accommodative policies. That could help demand for dry bulkers, because China is the main customer for most of the dry bulk orders and imports. The other thing is that because of the Ukraine conflict, so for instance, Europe or Germany cannot take coal from Russia, so they might be taking coal from, for instance, maybe they will have to take it from the US or even as far as Indonesia and so forth. So as a result of this, there'll be demand for ships to go for longer routes. So rather than take from Russia, they got to go all the way further distances, and this rerouting of ships will also help the demand. But again, demand, we can never be too sure. There's clearer visibility for supply. Next slide. So in terms of our target price, so our target price is 3 times PE FY22. So the reason for this is because the whole industry is trading at only 3 times, or maybe 3 to 4 times, depending. So these are the global dry bulk carriers. Most of them are listed on the US, like Star Bulk, Golden Ocean. Pacific Basin is in Hong Kong, and Precious Shipping is in Thailand. So these are the only 2 in Asia. So that's how we benchmark our target price, 126. The other thing to note is that, of course, the stock is also trading at 0.5 times book. We think this year, they don't have an official dividend policy, but we think the dividends should be strong. We are looking at maybe 12 cents dividends or 11% dividend yield. And So this will give a yield of 11%, right? And also this will be a payout of maybe about 50% and 13 million of dividends. So I think this will be the last slide for Uni-Asia. Next will be Phillip, our usual weekly. So in terms of the first bullet point, we continue to see very strong RevPAR for the hotels. So RevPAR is a revenue for hotels. So this is like occupancy and the room rates. So if your room rate is $100 and occupancy is 90, so obviously your revenue is about $90, yeah, for the whole hotel. So you continue to see very strong RevPAR. It's up 120% year on year compared to 69% last quarter. It's a very sharp rebound. So room rates or revenue for hotels in Singapore should be doubling at least for a month of May. And they are only 6% below pre-pandemic May. So it's a very encouraging rebound. The other thing that news came out was property prices. So HDB continues to climb up the property price. This is the ninth consecutive. So it's like almost 2 years plus of continued rise in HDB prices, which is going to be good for the private residential because of the upgrading cycle. So once owners sell, they may want to upgrade, and because of the equity. So this will be a positive virtuous cycle for residential. And I guess we also see this private residential prices are up 3% quarter on quarter. So this is a very significant number because on a 12-month basis, year on year, property price is up 10%, 10.3. This double digit, we have not seen it since December 21 when the government imposed cooling measures. And if you take that away, the last time we saw it was more than 10 years ago, in June 11, where 2011, 2012 was one of the hottest property markets before TDSR. So we are getting very strong property price rise despite the cooling measures. If we swing down to the US data, we have ISM new orders. This is very well used by the financial industry to have a gauge of manufacturing, the lead indicator. So it's actually very big. It's one of the weakest since 24 months, since the pandemic started. Core inflation, I think this is inflation number which the Fed uses. Their target is 2%, but it continues to rise. Although year on year is lower, but 4.9 to 4.7, but month on month, seems to be any stopping. So we're like on the 18 consecutive month of continuous rise in inflation. So the reason why month on month is important is that the early indications of a slowdown will be when the month on month starts to narrow, but we don't see it yet. The other commentary was from New York Fed. So this is because every other day you probably can hear one Fed official talking, but most important is again those on the FOMC, those who can vote for whether there'll be interest rate increase, and those are on the FOMC members, such as this New York Fed member John Williams. So I guess the key commentary, at least for us, is that they definitely need to raise interest rates or the Fed funds to 3 to 3.5 by this year. So if you look at the lower bound, so the Fed funds rate now is 150, 175. So you can expect interest rates to double, or at least another 200 basis points to 300 before they start to pause, which is their so-called neutral rate. This is also our base case. So in terms of tactical view, the US economy continues to lose momentum. What we think is also happening is that a lot of companies have over-ordered, and there needs to be a bit of inventory adjustment because demand is slower now. And the adjustment may be even higher than could be quite severe in the sense that because if demand contract and when you know that you have too much inventory, of course you will shrink inventory. But at the same time, if you see your prices, commodity prices weakening and inventory prices weakening, you would definitely not want to order anything. This is not my commentary, this is from the ISM, the survey, those who did the survey. So this is the comments that's coming up from manufacturers. So as a result of it, that's why you see the economic growth is starting to slow, gather momentum because there's a destocking cycle happening in the US. So for the Singapore residential market, I think we did speak to some real estate agents. So real estate is very hot right now, the property market. Most launches, you get like 70% take-up rate in over a weekend. Just to give you some context why the prices are exceptionally strong compared to. So since the cooling measure in December last year, property prices are up 4%. But when you look at the previous cooling measure in July 2018, it took us 2.5 years to cross the 4% increase in property price. But right now, it took us only 6 months. So you can see the strength of the property. The rebound in post-cooling measure is much, much faster than the last cooling measure in July 2018. So of course, this will be positive for someone like CDL, where whoever has inventory now is the I guess the winner, because inventory now is the lowest in nothing more than a decade in terms of the unsold property units. So it's really almost like a seller's market now, I guess. I'd like a better word. In terms of the webinar, this Saturday we'll have our quarterly strategy, and then on the 16th we'll have our US strategy. In August, we will resume our LISCO webinars, because right now it's cooling. Sorry, this is the cooling period, so where a lot of corporates cannot come out and do webinars because the results are coming out. So most of it will resume in August. Next slide. So this is the chart on the left, is the ISM new orders. It's a bit of a lead indicator because it will tell how are the orders coming for manufacturers in here. So you can see there's a sharp drop. It doesn't mean all the time you can see in shaded is the recession time, but it doesn't, no, sometimes it drops, doesn't mean there's a recession, but you can see that the contraction is pretty sharp this time around. The table on the right is, what we did was we took all the inventory of the big retailers like Amazon, Walmart, and then we see how were their inventory. So from 2019, you can roughly see the table on the right, the blue bar. Inventory of these 4 major retailers was probably maybe 80, let's say 80 billion. Right now, it's almost more than 130 billion. So they bulk up a lot on inventory, almost jump up 50%, because of course sales was up. But as inventory to sales, you can see the red line is at elevated levels, at the highest in more than 10 years. So that's why we think orders a lot of retailers have probably over ordered, and they probably need to adjust inventory. This is important because this won't be good for the economy, because they have to destock. Destock means the retailers won't be making any orders, so it's probably going to affect a bit of economic activity. Next slide. So this is the property price. The one on the left is HDB. You can see that we had this huge doubling of HDB prices since 2005 to 2013. Then since TDSR started to move sideways, it went down, then now it started to climb back up. The table on the right is the private residential price cycle. So the hot years was of course 2011, 2012, and right now property price, of course, is at the record levels. And the 12-month move is back to the 2011. So we're not seeing such a jump in property price since 2011. And you can see 2011 were probably the hottest years based on the chart. Yeah, okay, I think next slide. This is our model portfolio. We will usually give a review of our model portfolio. So on the right is the performance. So we outperform, but I mean, it's only a modest 1% gain. Again, this is just for illustration. And we outperform the market. So STI for the year first half is down 0.7. We are up 1%. In terms of the monthly performance, what did well for the model portfolio were all the mid-cap names. You can see Del Monte and HRNet. What did very poorly for us was the bank. So DBS was down 4. Past 3 months, DBS was down 17, and the OCBC was down 4, and then it was down 8. Next slide. This is just for overall market, again, just for reference. I mean, it's not predictive, obviously, but it's just for the reference. So what did well for June were the REITs. Okay, REITs starting to get a bit, I guess. What is happening is that the cyclicals have been hit very hard. So cyclicals means those most sensitive to the economy, so like banks and commodities. So you look at the top 10 losers, a lot of it was coal stocks, iron ore stocks like Golden Energy, palm oil stocks, First Resources, because palm oil was down like 30%. Palm oil price. The gainers was stocks like Silver Lake Axis, more company specific, and some of the hospitality because of GO there, and the small caps. At the bottom is the top gainers for the 30 STI components. And again, this is just for your reference. So a lot of the REITs started to recover. And the losers were the banks and sets, unsurprisingly. Next slide. Again, this is just for your illustration. For June, the worst performer, commodities have started to roll over. So you can see the commodity ETF. I think probably this is the first decline in many months. So these are ETF, so this is not some index. And again, STI was down 5%. This is on US dollar. Again, this is just for your illustration, it's just for anyone's reference. So gold was flat and bonds ETF is one of the worst for the year, down 17%. Okay, next slide. I think this should be the last one. Oh, okay, thanks everyone. I think we can move on to Q&A.
I'll take a few of the questions. I think I have one for me regarding OCBC. So the question is, since OCBC's performance is lagging behind the other two local banks, your views on why is it currently lagging? On why it's currently lagging and the outlook 3 to 6 months. So for OCBC, yeah, you're right, it's lagging. I think I did sort of like a report on the OCBC's PB ratio as compared to the other two banks in January. So if you can check that out to see a more detailed report. But one of the few main reasons why it's lagging would be mainly because the ratio of its interest, like its NIM and net interest income, is slightly smaller than compared to its peers, so DBS and UOB. And secondly, also because there was a period where they had increased allowances in and NPAs in their Indonesia and Malaysia economies. So this was for the same time period as DBS and UOB, but they did not sort of like report an increase, whereas OCBC did, and this affected their bottom lines. So they were actually showing lower profits compared to their peers. However, we actually do prefer OCBC as compared to the other two banks. And this is because it's also still a beneficiary of the rising interest rates. And its CASA ratio is pretty high. It's in between the two banks, so it's around 62% compared to UOB, it's around 55, 56. And DBS CASA ratio is the highest at 75%. So CASA ratio stands for current account, savings account. And also there's also potential for higher dividends from OCBC. It's mainly due to its higher CET1 ratio. So currently, even post the MES additional requirement, their CET1 ratio is at 14.99%. So this is still higher than DBS at 14% and UOB at 13.1%. So this would mean that there's potential for higher dividends as well from OCBC. So I hope that answers the questions regarding OCBC. Let me just look through again, see if I have any other questions. Okay, hold on. Oh yeah, there's one question about asking the target price for the banks. Let me just put it up. So for the banks, the target price we have for DBS is $41.60, OCBC is $14.22, and UOB is $35.70. I'll type that in the chat so that it's easier to refer back. Okay, I think that's all I have for the banking sector. I'll just hand it over to the rest of my colleagues. Thanks.
Okay, thanks. Oh, sorry, the wrong question. Okay. Let me just read out the questions. Appreciate your views on whether one should invest in the S-REITs or our retail bonds if one can make either choice. For me, if I had to buy, I'd rather just buy the S-REITs ETF rather than a retail bond. My worry is just that I think the retail bond yields are now about 2%, it's a bit low considering that interest rates might still climb another 200 basis points. I'm referring to a 2-year savings bond. So that's my preference. probably an ETF would be a better way so that you spread out across all the REITs rather than you take any particular one REIT itself. And because now the tax structure is better for ETF, because in the past there was some leakage, I think you still have to pay tax for S-REIT ETF. So I think that would be a better way. I guess that's my own view. Because I think if you buy a savings bond, it's virtually buying a bond at 2% plus. I don't think it's going to be that attractive because rates are still going to climb higher. Maybe at year end, maybe that would be the better time to consider a savings bond at year end, when you know that the Fed funds, because Singapore, we virtually just have to follow where the US rates are. So at least by year end, you know that whatever interest rate, any more increases in interest rates will be more subdued. But right now, the next coming July, August, you're definitely going to see at least another 150 basis point or 1.5 percentage points increase in interest rates. Then that will make your savings bond at 2%. I don't think it'll be that attractive. Again, this is just my own thoughts. Yeah. So I'd rather buy a S-REIT than a savings bond. I hope that helps. Hi, would the drop in SG government bond yield recent high to impact the S-REITs and banking and S-REITs? Glenn, you want to repeat it? Yeah. Okay. Let me just try. I think I don't think it will impact it will definitely benefit the REITs. I think now investors might be looking at REITs, although interest rates are high, are still continue to climb. I think they might just see REITs as a bit more defensive as we enter into this weaker period. But we don't, for us, we don't share the view. I think we still like the banks. And if you look at Glenn's earlier chart on loans growth, I'm not sure if you all can go back to the chart, whoever's controlling the slide. One thing, okay, the worry that investors have now is really the condition of the NPL cycle. So what we think is that the increase in, although we think that the loans growth, one way to detect the quality of the banking loan portfolio is to look at how fast loans growth has been. Can you go to that slide? Whoever's controlling. Yeah. So what we see is that loans growth hasn't been particularly strong. So one thing because for any investor, when you invest in the banks, you never know. Back up, one more up. Okay, so this is the chart. So as an investor, you will never know the quality of the bank loans. But the only assurance you can see is that hopefully they didn't overlend the last 2 years. Then at least there's less risk of an NPL or provision cycle. That means they have to provide for bad debts and it's going to hurt the bank profits. So as the bullet points say, you got this in the global financial crisis where the banks, their loans growth was like 5 times this per year. So it's quite a lot. So they were outgrowing the economy. So why this is important, what it means is that they were lending faster than economy. That means it ends up in assets and ends up not for, I guess, economically productive use. So we don't see it over the last 2 years. And for the last 2 years, in any crisis, there's always a margin call. So in a global financial crisis, the margin call was a lot in the US banks, that's why like Lehman and all that had to fail. So right now, we think the margin call is at the cryptocurrencies. So that's why we don't think that the Singapore banks are going to be hit that badly. But having said that, the impact for the banks will come from 2 things. Of course, you will see wages climbing. So their expenses will climb a little bit faster because staff costs will definitely be higher this time around. The other pressure point is that the banks we think will probably creep up on the general provisioning. Because how banks do their general provisioning means you have to provide a little bit for bad debts, regardless whether even though customers are paying well, you still have to provide because they got this ECL rule whereby if the macro data is weakening, they have to probably impute it into their model and so forth. So there might be a bit of higher general provisioning, but we don't think it's going to be meaningful to impact the banks. Yeah. So I'm not sure if that actually answers the question, but yeah. Okay, Natalie has Natalie's last day was last Monday, so she is no longer with us. Our new our new lead analyst is already with us, so give us some time for the licensing. We'll have our new lead analyst coming online soon to answer some of the questions. But let me just look at this up. So for the EC world, so I think this is a similar thing that's happening for TASIN, for some of these Chinese REITs, is that they have difficulty refinancing. So this is going to be so as a result of this, they've extended the refinancing for EC World REIT up to April 2023, and they probably have to sell some of the assets. I think this happens when your sponsor, the problem with REITs, I guess, not just for any Chinese REITs, is you have to rely on strangers, you have to rely on the banks. So I think what's happening in China, because of the 3 red lines, so some sponsors might have crossed it. I do not know, I'm not speculating, but that would probably cause some issues with a lot of these REITs. I think that once you have a refinancing risk, there's no amount or level how much the share price, because the solvency of the REIT is in question. Because if you don't have debt, because as you know, the nature of REITs, they don't have any they have no reserves. Whatever they collect, they pay out. There's virtually no money to pay the banks. They have to rely on banks refinancing, or they have to rely on banks, or they rely on asset sales. So it's definitely justifiable. Once you have a refinancing risk tag on and solvency is an issue, then solvency liquidity is an issue, then you can't say how low is low, because it can virtually go bust. I mean, on paper, they can't refinance it. Then the bank will make a call. Basically, the banks can ask you, can you pay me back? Then if you don't have, REITs don't have any reserves. Yeah. So that's the latest development. Okay, let me run this again. What considered the share price drop in Uni-Asia from 137 to 104? I think it might be just the Baltic dry rates must have come down. Maybe that's why the price has corrected. But any long-term worries? No. We think they probably can go into net cash position by next year. I think FY23, because if the earnings come as what we forecast, this company can swing to net cash very soon. So I think financially there's no real issue for them. Hi, Nat. Okay, can you give your thoughts on TASIN Retail Trust with regards to latest? Could you comment on Zhangzhen's recent buyback? Yeah, sorry, we can't really comment much on it. But I guess the one difference between EC World and TASIN is that TASIN there's a big SOE coming to support TASIN. So that's the big difference. Sorry, I just slipped my mind which is the company, but the difference is that as a SOE has already bought a stake, I think, in TASIN, and also bought a stake in the retail. So they've shown commitment to buying it. So that's the big difference. You have a SOE backing for TASIN. Terence, you want to take on the capital one before I move on?
Yeah, sure, Paul. I'll take the capital question. Oh, sorry, let me just find the question. Yeah, okay. Capital Corp is trading sideways. What is your take, hold or sell? So for Capital Corp, the current overhang is the deal transaction they have with Sembcorp Marine. The deal with Sembcorp Marine is currently undergoing. They are currently applying for clearance from their overseas regulation, overseas regulatory approval, because they operate in a number of jurisdictions. So they have to apply for clearance from these different regulatory approvals, regulatory jurisdictions, before they can proceed for the vote from both Capital Corp shareholders and also Sembcorp Marine shareholders. The reason why it is trading sideways now is because there's still a little bit of uncertainty in the market. as to whether they will be able to push the whole deal through, and that is why that's why it's flat now. So our take, in terms of our take now, we still have a buy rating on Keppel. Based on their last quarter results, all of their businesses are still, their core operating businesses are still performing well, and so we are still maintaining our buy rating and our target price of $7.07. Yeah, I think that's all the questions I have now. I'll hand back to the rest of my team.
Okay, thanks, Dan. I forgot to put mute. Oh yeah, okay. Someone asked what is the SOE. So SOE is a state-owned enterprise. So the one that bought a stake for Tasin is a Sino-Ocean, which is owned by China Life Insurance. Yeah. That's what we mean. So state-owned enterprise. Okay, let us try to Asian Pay TV coming down strongly last week. Any risk of a dividend payout? Because yeah, we did a analysis, but there's more than enough cash to pay for us, because their free cash flow, which is excluding capex, is about 70 million versus their payout is about 18 million. So we did, even if interest rates rise, there's more than enough to cover the 18 million or 8% dividend yield. But you know, this is unlike this one, they actually have capex, so there's actually money reinvested in the company and the business. So we don't see any risk in them continuing with their dividend payout. Any views on HRNet, rather illiquid? So we still like HRNet because when you look at the metrics, sorry for those who heard it before, the metrics are very unique and very rare because the ROE is exceptionally high. Depending how you want to play around with the cash, because the cash can be accessed, so they have very little capital. So we think they will still report very strong earnings because of the job market is so tight, number one, and they continue to expand regionally, and they got like more than 700 recruiters. So that gives them a very high barriers of scale. Yeah. So we still like it, but again, the company is doing a 30 million share buyback, which is, I guess, even though it's very thin liquidity, it's like 6 months of volume that they're trying to buy back. But again, I guess the flip side of it is they're just going to absorb all the volume. Any estimate of the intrinsic value? So for us, Uni-Asia, how we value is 3 times PE. That's how we got with a target price of 126. Yeah. Sorry, when you look at the slides, the target price is at the top of the page. Yeah. Sorry, I didn't mention it. Any idea why Suntec is down? I'm not sure that I'm not sure if Darren can help, but it could be the hedging of interest rates. From what I understand, I think now what investors are looking at is who has not hedged their interest rate exposure that well, and number two, who has to do refinancing. I don't have the data in front of me, but I guess one way to separate, because by next year, when interest rates are high, you have to do refinancing. So those who have to do refinancing or very lumpy refinancing, the second half or even next year, you probably get the biggest impact on interest rates exposure. But most of the REITs have hedged for the next 1 to 2 years. But it doesn't mean you won't feel it, but it just means that they are at least protected for the next 1 to 2 years. But the most exposed to those who didn't hedge, and you won't hedge it usually when you're going to do a refinancing, because you can't hedge, right? The banks have to refinance. I don't have the data off the top of my hand, but that's one way to assess who is most exposed to the rising interest rates in the very near term. Okay, will Sheng Siong emerge as a winner again if the recession hits? It could. Again, it depends how it could, in a way, because they will be seen as more defensive. Because Sheng Siong is more consumer staple, so regardless of economic cycle conditions, people will still shop in Sheng Siong. Number one. Number two, they will still ride on the whole taking share of wet markets, so they continue to do that. Number three, for Sheng Siong, the one that's less certain, although some may try to promote it, is that because when there's food inflation, households might shop more at the the value grocer, which is Sheng Siong. But again, it's very hard for us to confirm it because it depends on competition. I know if NTUC also want to cut price, so no matter how cheap you are, there's a price war. So in the recession conditions, these are the three reasons why Sheng Siong might be more resilient. I'm not sure you call it a winner, but I guess it'll be more resilient. I hope that helps you. Please discount on Escort. Yeah. Okay, Fastnet is not around. Again, we still like Escort, and because again we still like the reopening stocks when borders reopen. Just as much as we can. I don't have the details, so sorry for that. You just have to give us some time till we find our lead analyst to come on. Okay. Likewise for Capital, do you expect Capital DC REIT to outperform better ahead? What kind of dividends does it give in 2022? I think the yield is 4%, 3 or 4%. Yeah. I guess for us, at least for me, I mean, pending our new analyst, probably my least favorite among all the REITs, because there is very little for Capital, because Capital DC is pegged as a growth REIT, but most of their growth come from acquisitions. But if the share price continues to weaken, then this big growth driver is going to be hard to repeat. So that's my own reason. And you can see digital calls also kind of come off. I think that one is mainly because of don't have enough hedges in the interest rates. And also if you're buying an asset, because data centers are very well beat up now. So the cap rate or the yield for most of these assets are maybe 3% or low, because there's a lot of competition. Everyone's trying to buy a data center. But when the Fed funds rate is 3%, I'm not sure how attractive these data centers are. So that's why for me, I'm a bit more wary for Capital DC. Again, this is just my own view. Okay. I'm going to stay away from this ARA Logistic Trust because we don't have a REIT analyst, so I try not to answer that. Give us some time until the new analyst is up to speed. What's the key point to discuss these two counters? Is it better to concentrate what audience interested? Yeah, sorry, not really clear which counters, but usually we will discuss stocks that have we came up with a report. So normally when we generate a report, then we will talk about it. Yeah. And we will try to talk about whatever company analyst briefings that we've gone to share with everyone. So that's why we talk about these two companies, or if there's any major news. Yeah. But as you know, Singapore not much news. So usually the reason we will do slides is Phillip on the ground. Basically, when we go for analyst briefings and we know a lot of people cannot make it, then we will share whatever we can to help you. How foreseeable is the US recession due to rising interest rates going to impact Singapore equity, banking and REIT stocks? We think even if there's a US recession, again, it could be a bit more shallow. Number one. Number two, most of the equities are down 30% from the peak, and usually that is the amount of downside when there's an upcoming recession. So we think the US equities have priced in quite a bit. And then we think when the economic data continues to weaken, we think by September, after the next Fed meeting, there'll be a July coming up, September. Our base case is that I think the Fed will slow down. More aggressive, they might pause, but they might just maybe guide the market that they won't raise interest rates so much. And then that's why we think that will set a good basis for a rally in the fourth quarter. Because then the Fed will pause. Because right now, nobody knows how weak the economy will be, because if the Fed continues to tighten again. Yeah. But for Singapore, if you look at all the data points, there is no real significant slowdown in a lot of data points. Jobs are ample. Manufacturing data is very strong. It's about 9%. Manufacturing is growing about 9%. Compared to, I think, 3 to 4% pre-pandemic. So manufacturing activity is still growing faster than pre-pandemic. And then if you look at foreign direct investments into Singapore, we are back to almost record levels. I can't remember the exact number, but if you look at the chart, we are back to the 2019, very close to 2019 in terms of foreign direct investments in Singapore. So, and we have a reopening. So I don't think Singapore would enter into a recession. It's far from it, but It's just only the sentiment. So that's why we think that's the reason why we still like banking stocks, although we've been sold down. REIT is a bit more precarious because REITs, if REITs are trading at 4% now, like some are, like I think Fraser Center Point maybe 4 or 5, you know, and interest rates are going to hit like 3-4%. I'm not sure how attractive it's going to be. Yeah. Yeah, for the Hua Hong, sorry, we didn't really did much analysis on it. Sorry, we can't really help you on it. How is it that StarHub price did not improve with the reopening of travel? Yeah, it will take time because the reopening only started in May. So even in the second quarter, the roaming revenue for StarHub, you may not see so much of it yet. Because the only place that people are traveling now mainly is, I guess, Malaysia or maybe a bit. So you don't really see you won't see the roaming. It's definitely recovering, but you won't see it fully until even China has to open. Because most of the revenue for telcos like StarHub will only have is mainly Malaysia and China. I think 1/3 of it is mainly Malaysia, then another 10-15% could be China. So until this China really fully opens, you won't get the big jump. But regardless, I think the next 2 years, our view is that you'll get this big tailwind. Every quarter as the economy opens, you're going to get more and more earnings from roaming. But it's not immediate, you're not going to get a big gap up. What's your view for Singapore housing? How high will they go? What are the... Yeah, I think the worry right now is whether the government's going to come back in again to another cooling measure. But because again, like we highlighted before, whenever property price cross 10% or double digit, the worry is that they will start impose cooling measures. Maybe not right now because it just did one 6 months ago, but it's definitely going to be a benefit for all the property developers. Again, from the real estate agent's point of view, whenever property price costs 10% after 12 months, then the authorities' view is maybe 5 years, 50%, so not sustainable. But there is a risk that if property price keep on climbing again, then there could be, I wouldn't be surprised, maybe another 6 months if they keep at this trajectory, they could impose another round again. And maybe that's why a lot of people are also rushing, because they know that one of the reasons why buyers, most of the buying is still 80% local, a lot of first timers too. And one of the reasons they're buying is because they continue to see prices climbing up. Again, it's a bit of a momentum. Don't ask me why, but that's one of the reasons given why there's still the take-up rate is so high. And of course, the inventory is also very low. I think last year, the number of launches was about 10,000 roughly. This year, at most, is about 7,000. That's what the information given to me. Why did the REITs rally recently? The REITs rallying because it could be seen a bit more defensive than the cyclicals, and also because the 10-year came off. I think when the economic data in the US was very weak, especially the ISM numbers, I think the bond yield started to come off in the US, and that's why interest rates started to come on. That's why you're getting a bid for REITs recently. Glenn, you want to take the Silver Lake one?
Yeah, sure. So there's a Silver Lake question. It's a good call on Silver Lake. Any thoughts on why Silver Lake is above your target price now? So Silver Lake, we have a few key drivers on the key growth drivers for Silver Lake. So firstly is the Mobius, which is their new banking platform, to be the differentiator. And the second one would be the recovery in bank IT spending. So this might be the cause for why it's growing. So after 2 cautious pandemic years, you can see that the banks are increasing their interest rates, as well as they're expecting to grow after the 2 pandemic years. So this will also relate directly back to Silver Lake, where they can, if the banks spend more, then definitely they will have to expand their IT and their database, as well as their core banking. So with this, Silver Lake is also expected to grow equally with the banks. So that might be one of the reasons why. And we are currently reviewing it has really exceeded our target price, so we will definitely review this our target price. Yeah, I hope that answers the question. Just scroll through briefly. Okay, I think that's it for me. I'll hand it over to the rest. Thanks.
Sean, you want to take the how recession will affect bond prices or points?
Yeah, sure. Give me a moment. Yeah, so regarding the question on how recession will affect bond prices, right? Because currently right now we are in a rising interest rate environment, and everyone is also expecting the increase of the Fed interest rates going forward in the second half. So bond prices would definitely be, negatively impacted because due to the inverse relationship of the bonds. But currently, there are quite a few corporate issuance that are pricing in at a much more competitive rate in terms of bond yields. That's why I think currently there are quite a few numbers of issuance, such as the recent, give me a moment, the recent ABN banks that they recently issued the cocoa bonds at around, if I'm not mistaken, I think it's 8+%. Yeah, so they're trying to be as competitive as possible. Yep.
Yeah, any once there's a recession, definitely bond yields will come off. Yeah. Because when there's a recession, then the Fed needs to stimulate the economy. They're just going to cut rates back again. Okay. Let's try to move on. How is the Shimao's default 1 billion loan impacting property market or REITs equity value? Yeah, there's virtually no direct impact in Singapore. It probably is a more of a macro impact. Yeah, because property, in China is extremely critical for the purpose of wealth, obviously, and also more important is that I guess most of the banking loans in China, they're all collateralized by property. So property market cannot collapse in China. It's going to be a systemic risk, not just for China, but for the whole world. Yeah, so that's important indirectly, but in terms of direct impact, I don't really see how Shimao can impact values here. And I guess, ironically, once you have all these defaults, right, it kind of deleverage the system a little bit. And of course, so long as there's no collapse, there's no systemic issue. So all these deleveraging events might be actually kind of good for the Chinese banking system. I mean, if if it doesn't cause any major downfall, that means you're de-risking, you're taking out all the tail risks, those who are over leveraged and so forth. I mean, ironically. When there's a slowdown in inflation, any thoughts of which sectors will lead the recovery? Inflation is the biggest macro call for this year. If you can get your inflation call correct, then the whole market will rally if inflation starts to collapse. I mean, starts to come off, except commodities. You can buy REITs, you can buy, even banks will also run, because then they see the recession, the Fed will not raise rates anymore. So tech sector, any of the deep cyclicals, except commodities, I think then will definitely run. The whole market will run. Yeah, the biggest call is if inflation starts to deteriorate. Yeah, especially the tech. I think just by any of the worst tech names you can find in the US, that will be the highest beta. That will be the one that will run. Inflation starts to drop in the US, because the whole market's going to rally. Can you comment on Ascender Suites? Yeah, sorry, I will leave all the risk questions out for today. We'll try and get back to you. Yeah. But do not worry, even though our risk analyst is not yet ready. Whenever we have any analyst risk briefing, we will definitely give everyone an update. So expect that in the next one, this week onwards, when SPH read everything come up, we will definitely brief everyone on what's all these analyst briefings, what are the key things for everyone. Yeah, okay. Can you comment on first REIT compared to Parkway Health? Okay, this one maybe I can give you a bit more comment since we just met first REIT. Okay, for first REIT, the main difference is that you're still buying some, you're getting Indonesia rupiah exposure. I think that's the main thing. Because for first REIT, unlike in the past, the parent actually, Lippo Karawaci was the one that promised all the dividends. But this time round, they're going to pay in rupiah, so you get a bit of rupiah exposure. But the only thing is that you're compensated because they are pegging it to the CPI. Yeah, they're pegging it to the CPI, so you do get some rupiah exposure. So I think that's the main thing. I mean, Parkway Health is very stable, but again, I'm not so sure why people are so hot on Parkway Health. I guess because right now if you want to buy any REIT, I think you need a REIT that can grow rents. You need growth in the REITs because otherwise they cannot outpace the interest rates and so forth. So then they become more like a bond, and you do not want to buy a bond like REIT, right? So for us, we prefer, that's why we like Escort REIT, because with the rebound, we think Escort REIT will do well because there's a big you're very hedged towards a recovery in travel. And you already seen in Singapore, like we showed you earlier, there's a big jump in RevPAR. There's going to be a huge recovery in the hospitality industry, at least in Singapore, and likewise elsewhere. So that's why we still like Escort REIT the most, because even though interest rates are rising, you're going to get protected because your rental is going to outgrow this. Yeah, Paul, I really don't like Singtel splurging money in Thailand. Yeah, I agree with you. Spending broadband broke Philippines, right? On the other hand, divest Optus Tower potential MOB. Where is the capital discipline? Yeah, I do agree with you. Yeah, it's like one thing good, one thing negative. Yeah, I agree. I mean, I'm not very sure because AIS just bought a US $1 billion funding. Yeah, and again, the value shouldn't be buying infrastructure. The value should be how do you monetize the infrastructure more. So I do agree with that. No, don't dispute that. Yeah. So I got no other comments on that. So it's a bit disappointing. They're going to hopefully divest one, but then they acquire something else which may not be very high returns in this business. Yeah, rather than buying more soft assets, creating something rather than just using cash to buy growth, which has always been their habit. What is DCRU? Is it digital core? Yeah. Okay. So digital core and Suntec was down mainly because there was a report out that showed that their hedging was only 50%. So it wasn't as high as the rest. So I think, so that's why the sell down. So they are considered the most exposed, I guess, amongst the REITs towards rising interest rates. Again, sorry, I'm repeating myself, but I mean, that's the reason why. Paul, are you still positive with Olam, with the recent Olam financing loan with IFC? Is Olam paying? Yeah. All this, yeah, I think the key thing is the ability to list. So even if the unfavorable interest rates might be 1-2 percentage points, I don't think that is the main thing. The main thing is the ability to list. So we still think that's in the cards, but you might have to wait a bit longer because the capital markets are still weak. Yeah, I hope that helps. Not much chatter on China performance on the region vis-a-vis US performance. You have the rough crystal ball. Yeah, I think China should again, my own guess, I'm not a China expert, probably got this wrong, but I think we're beginning to see the cases starting to shrink, and they're starting to be they're starting to reopen. And I guess the main one will be the big meeting in China in October I can't remember what's it called, but there's a big the key meeting now to re-elect Xi Jinping. Yeah. So post that meeting, maybe they will relax the economy a little more. And that's the reason why we like hospitality, like Escort REIT. So you can imagine if China really, not now, maybe next year, they announce we're going to open all the borders, tourists will travel, stocks like Escort REIT will just pop up because the tourism from China is coming up again. So that's the reason, one of the reasons why we like, of course, we do not know when is the timing, but that's one of the reasons why there's always potential if China announce borders are completely open. I'm not sure when, but if you assume next year or what, then there's a big gap up opportunity for escort. I mean, just one of our views. Because we know everything, we have to take an 18-month, 12-month view. So if we take that, then that's why we like escort. Yeah, please comment on escort trust. Yeah, sorry, I don't have the details. So again, please be a bit more patient. We will try to get back to you with our re-analyst to help you better answer the re-analyst question, because obviously mine is not good enough. Okay, I think that's the end of the questions. So I'd like to thank everyone, and apologies. I think there were a lot of read questions. Apologies if we can't really answer them well enough, but just give us some time. When the analyst is up to speed and get out the licensing, then we will definitely help you answer most of your read questions. So thanks again, everyone, for your time. And I do hope to see you on Saturday if you do have some time to spend with us. So thank you, everybody, and take care and have a good week ahead. Thank you. Bye-bye.